So good afternoon, everybody. My name is Rachel Stark. I'm the head of Aftersales at Resi. For those of you who don't know us, Resi is the customer-facing brand name of Resi Partnerships, and we're exclusively focused on shared ownership. We work with a wide range of organisations to support them with their shared ownership products and processes, and hopefully help make home ownership possible for more people. Now, the purpose of our webinar today is to take a closer look at one aspect of the shared ownership world, namely after sales, and share some of our experience in tackling the challenges that all after sales teams will have faced this past year. So whether you're a for-profit, a not-for-profit, whether you're small or large, and whether or not you're considering external services to support you with your after-sales processes or not, I really hope that today's webinar will provide you with some useful information and let you know that you're not alone when it comes to preparing for all the challenges that are ahead. I'm also joined today by Jon Lord. You can see us both on the screen there, and hopefully you can see our faces in the background. He'll be giving us a bit of an overview of the property market. Jon Lord's Managing Director at Metro Finance. So if you want to ask any of us any questions, there should be a sort of a Q&A box at the bottom of your screen. Pop any questions as you go along there, and we'll answer them all at the end. Now, over the course of the next 30 minutes or so, we're going to discuss what a great after-sales team might look like, and we're going to talk about some of the challenges and opportunities facing anyone working in after-sales. So whether it's the requirements of the new lease, the end of Help to Buy agents, or the introduction of new trading standards requirements, there's been a lot to get to grips with recently, and that's on top of all of the changes to the markets. And over the years, we've seen that after sales volumes are typically pretty sensitive to economic changes. I'm sure everyone on the call enjoyed the positive impact that the stamp duty holiday had on the market up until the end of 2021. But since then, it's been a bit more turbulent. And the rise in interest rates towards the end of the year certainly caused a lot of uncertainty. And we saw a slowdown in transaction volumes in the last quarter of 2022, but we have seen things start to pick up again in the new year. So I guess the question is, what has the market got in store for us going forward? And at this stage, I'd like to hand back over to Jon, as he's far more qualified to discuss this than me. So he's going to talk to us a little bit more about recent economic events and the likely trajectory for interest rates and sales volumes. So I'm going to stop sharing my screen briefly, Jon, and hand back over to you.
Thanks, Rachel. Hi, everybody. So I'm going to give you an update on the shared ownership mortgage market, how we see it at Metro, and what's happening with, or what we see from the data sets we have at Metro, taken from over 30,000 assessments. So the first thing we need to look at is, or understand, is what is good in the shared ownership mortgage market. And over the years, one of the benchmarks I've always looked at is the number of shared ownership mortgage products available to borrowers. So that's your 2-year fixed rates, your 5-year fixed rates. How many of those are there? And my benchmark is, a good market looks like around 75 products for 5% deposit holders and about 200 products for overall for any deposit size. Right now, we've got 101 products for 5% deposit holders and about 237 products overall. So really reflecting lender hunger to be involved in shared ownership. And we hear that with the calls we take from lenders asking how they can get more shared ownership business. And when you've got big product variation like that, 237 products, it goes hand in hand with criteria variation, which helps satisfy buyers from all different walks of life, in turn helping to sell shared ownership properties. The second benchmark I look at is the lender numbers. How many active lenders are there? Right now, we've got 29 active shared ownership lenders, 19 of those lending at 95%. Incidentally, that's more than Help to Buy equity loan had even at its peak. And you only have to cast your minds back to 2016. Back then, we had 17 lenders, around 8 lending at 95%, and the market functioned perfectly back then. And I think it's safe to say that right now we've got a mini rate war happening amongst the lenders. And that's not driven by lowered cost in funds, although it may be partially due to that, but largely due to margin cuts amongst the lenders as they try to cut the margins to make the products look better, to get the volumes through the door. Absolutely crucially, there is no evidence of any significant criteria changes or scoring changes amongst the shared ownership lenders. Now, you may well ask a mortgage advisor sat at the coalface, and they may say that, yes, it is harder to get deals through lender A, B, or C. But if you look at data, the overall picture of, say, Metro's conversion rates from assessment pass through to AIP through to mortgage offer, there's no deterioration, which tells me that the overall pool of lenders doesn't have significant changes. Maybe the odd one does, but that gap is plugged by another lender. I also expect more lenders to enter shared ownership this year, maybe 2 or 3, with one probably entering April next year. The absolute main issue to contend is the glaringly obvious one that fixed rates are circa 2% higher than they were in August last year. Right now, 95% rates would look about 5.5%, whereas summertime last year, you could get yourself a 95% 2-year fix for about 3.7, so roughly 2% higher, which causes more buyers to fail affordability in shared ownership, not just because of that, but because of the cost of living crisis as well. Now, you could, as a shared ownership buyer, get yourself a lower variable rate, around about 4.5%-ish, but variable risk isn't for everybody. You have to be able to stomach the chance of rates rising. And when we're looking at customers who can't ordinarily afford to buy on the open market, it's perhaps too risky for most shared ownership buyers. That kind of leads me to demand. Now, this first bullet point that you see, no sign of slowdown in shared ownership. To me, that's a massive understatement. At Metro, we work across the country with 100 housing associations, and we run at 2,400 assessments per month. That's our normal average. Then in November last year, we started to see an uplift, and January, February, March, already in March, has hit 3,800 assessments. That's not due to extra sites, that's just due to extra footfall, roughly a 58% increase. And it's going to feel for a minute or two like I'm just banging bare facts at you, statements at you, which I am, but I'll come to a conclusion in a second. Interest rate rises, they're going to impact open market far more than they will on shared ownership. Proportionately, if you take a £200,000 mortgage versus an average 100,000 shared ownership mortgage, it takes more pounds out of your pocket. And that same effect is on lender affordability calculators, proportionately impacting open market more, therefore creating a fallout effect from the open market into some other tenure. Since March of 2022, average shared ownership incomes have risen 16% nationally, 11% of which was the north, 24% of that in the south, which is a massive increase. The average share taken from 30,000 assessments in a 12-month period has held at 43% to date. So where are we heading with this? Well, it's pretty obvious, talking to lenders, economists in lenders, directors in lenders, and looking at the swap rates, how lenders achieve their fixed rates, the interest rates, the fixed rates for mortgages that we see aren't likely to drop anytime soon. So tail end of this year, we're probably going to be stuck with similar rates to those that we see today. But throughout all of this, the affordability pass rate has remained at 54%. So of those 30,000 assessments, 54% of them passed at some level of share. The fail rate, which was 14%, has now hiked up to 20, some months hitting 25% of all assessments fail. Income levels have risen 16% nationally. The average share remaining at 43%, and inquiry levels up 58%. So what does it mean? Well, I don't think anybody listening to this would doubt that affordability has become more challenging. We've all got shorter arms, deeper pockets, or whatever that saying is. And without a demographic change to the shared ownership buyer, the average share would have fallen, and that pass rate of 54% would have dropped, but it hasn't. So passing is what I determine a new type of shared ownership buyer, and I think that's somebody who's been to the open market, new build or resale, failed affordability, and fallen into shared ownership, their second choice of purchase type. Whereas the old, more traditional type of shared ownership buyer, the ones we see more of them failing, that's gone up to 25% in some months, is perhaps somebody who lives at home with mum and dad or is renting, has perceived that their only option to home ownership is shared ownership, their first choice. So very different buyer set. One is the second choice, the old type is the first choice. So perhaps for the very clever marketing people, there's an opportunity there to attract more of this new type of buyer. But what about the rest of the market? Well, I think it's pretty evident that people who would have purchased open market are now buying shared ownership because of the demographics that we now see. Inquiry levels, depending on who you talk to in the open market, lenders, large brokers say they're down between 30 and 50%. And that's mainly due to the higher interest rates that we see and the affordability challenges that we all feel. So because of that, I think it's reasonable to assume that the current demand, that 58% increase that we see for shared ownership, will continue for the short and medium term. So maybe seeing 4 or 6 buyers per property, qualified buyers. So we have this really unique challenge of higher demand, yet at the same time, more fails and a greater volume of passes. So how do we adapt to that? Well, shared ownership itself, it stands up to these market conditions. You could label it as designed to make the unaffordable affordable, but our buyers also have to stand up to these market conditions, making affordability and sustainability far more important than they've ever been since the crash of 2008. So you have to have a reliance on your mortgage advice firm, your IFA, who does your assessments, and complete trust in them. You can't have an over-reliance on the HEC calculator. Now, the phrase I'm using there, I pinch from Homes England, where they say that an over-reliance on the HEC calculator, or perhaps termed, if you're waiving the HEC calculator, an auditor to say it's affordable because of this, it's likely to fail an audit because it isn't an affordability assessment. It's only part of it. You need your bank statement assessment, your budget planner to go with it. Shares maximised individually. So historically, we've always looked at 45% as the max, whereas now it's a range in the capital funding guide. And in a climate like this, we've got to think, is it sustainable for the buyer? So sometimes it might fall less than 45, might be 30. That's okay. But it protects the buyer and the housing association, which in turn protect the really good shared ownership lending that we have, because it gives lenders comfort to know what happens before the cases reach them. Which leads to the sales process. I think affordability right now, it needs a very high weighting within the process, just like a lender would in a climate like this. In the underwriting process, there's more weighting put on the affordability process, making sure that everyone's who's doing your assessment is qualified and experienced. Now, experience is a new term that they've got in the capital funding guide, and I asked Homes England what they meant by experienced and how does a housing association determine that the firm is experienced? And they answered back to me to say that that's down to the housing association to document and demonstrate how they've judged the firm experienced. So one that needs a bit of thought on, I think. Make sure you've got a full process, a full sign-off process for your affordability checks, so it's audit proof. That you've got a document that explains why the share is what it is, why it's maximised, why the debt to income is what it is, so it won't fail audit. And I think if we adopt changes like this in the sales process in the current climate, that the buyer, the housing association and the lender will be happy, and we create a happy shared ownership journey, not just now, but in 1, 2, 3, 4 years' time, when arrears rates aren't higher than they need to be, which in turn protects our shared ownership lending. So absolute key is robust affordability. Back over to you, Rachel.
Thank you, John. Let's share back my screen. Brilliant. Hopefully that's given you some useful insight in, I guess, into what the market is doing now and what we might face in the future. I think what is probably quite clear from what we've seen recently, though, is that the next 12 months may well be unpredictable. I think that leads us to one of the biggest challenges facing anyone with, sales or after sales teams, which is how do you resource them effectively to ensure you can manage fluctuations in demand? And I've spoken to quite a few sort of fellow after sales heads or managers since I started this role, and there's surprising variety in the ways after sales teams are structured and resourced. So I think one question is, how many people do you need to deliver a good service, and what skills and background experience are needed, and also how, as we said, how should that department be structured? I don't think there's any single correct answer, but one thing I do know is that even with the best technology supporting you, you need more people than you think, because customers expect a lot. And it's not a service that is necessarily provided for free. Many providers charge an administration fee for staircasing, and nowadays most of us are charging 1% of the full market value for a resales property. Now, the average estate agency fee in the UK is 1.18%. So our prices are pretty comparable to the commercial world, and I think that means we need to offer a service that's comparable too. So what does that service look like? Well, I think it means professional photos and floor plans, a strong marketing strategy, hosted viewings, proactive sales agents, automation, digitization, and a seamless customer journey. Now, that's quite a lot easier said than done in after sales, where you might have a geographically disparate portfolio, you probably don't have a physical presence, you might not have sufficient volumes to support the required marketing spend, and as we said, you might have a sort of inconsistent or unpredictable sales rate. So I think the first question to ask, and it's certainly one that I asked when taking over the team, is can we actually provide this service to the standard that customers expect? And if you can't, then I think it's worth considering going to someone else to help you, because it requires both excellent people and excellent technology in equal measure. So let's look at people first. Let's take resales as an example. How many resales transactions can a consultant handle? Well, I'd be quite interested in seeing what people think. So I'd like to do a quick poll, if that's okay. So this is, I've put down a few answers here. How many do we think someone could, a single consultant can handle at any time, ranging from between 5 to 10 or 50 plus. So I'm going to launch a quick poll here. It should appear on your screen any minute. In fact, it should be there now. So if you click what you think, and let's see what the views are. Oh, it's whizzing away in the background. Leave it open for a couple of seconds more. Oh, there we are. End poll. Oh, no, it's still going. Nearly everyone's answered. Some people are sitting on the fence and keep it playing their hands close to their chests. But let me end it now. What I can see here is a variety of responses, actually, but most people are sitting, interestingly, between the 10 to 20 mark, that's where the largest number sit, and between 20 to 30, which is actually, oh, in fact, I can share the results on the screen, apparently, there we are, which is actually slightly lower than we do ourselves. So let me show you what we do. We do 30 to 40 is sort of where we think is reasonable at any given time. Obviously, we like to be at the lower threshold of that, but we think we can just about cope when we get up to the higher volumes. Now, if you're doing less than that, and either way, if you've got high volumes of transactions, that can result in needing a pretty big team, which can obviously be a lot of expense. If you're smaller, on the other hand, there's kind of going to be different challenges. You know, how do you ensure someone's sufficiently skilled and trained on a complex process that they might only do, you know, a handful of times in a month? And how do you make sure you give a consistent service in that instance? And equally, how do you deal with fluctuations like we mentioned before? Do you have lots of people who can sub in and out, or do you have experts in one particular area? So let's survey people again. If I asked you, how do you structure your team? Do you have a team of specialists where they maybe focus on one very specific area, such as resales versus staircasing? Do you have generalists where they cover both resales and staircasing, so the whole after sales profile? Or do you have multitaskers who do a little bit of everything, but home ownership, lease extensions, resales, etc.? Be interesting to see what people do there. So let me launch this second poll and see what people do here. Should be open on your screen now. Oh, it's looking very mixed, the answers so far. A few more seconds. See this last people. Cool, I'm going to end that now. It's very even, I think. John, just give me a thumbs up that you can see that on the results on your screen. You see the results? Perfect, okay. So actually, quite divided here, but we're generalists, interestingly, being the least. So people, but you can see the highest there being multitaskers. So really people trying to do a little bit of absolutely everything, which I think is also quite interesting. So what do we do ourselves at Resi? We have the structure below. We've actually focused on ensuring our team are specialists in their specific area. So we divided up the team as you can see here. And we've got really specific people, even down to granular level of resales, progression versus front end. And we found this has worked well in developing experts and strong skill sets. But obviously, we do have to make sure individuals are flexible and trained sufficiently to sub in and out of teams as required in case volumes fluctuate. Now, this structure isn't going to be right for everyone. There's no right answer. It really depends on the size, obviously, of your business and scale of your operation. But I think for us, this specialization has been one factor that's led to a real uplift in customer satisfaction and a more efficient service. So we currently have a Trustpilot rating of 4.6, something that we're really proud of. And I think those two measures of customer satisfaction and efficiency are intrinsically linked. Everyone knows customers are really demanding and property transactions are notoriously stressful. So we need to do everything we can to be as efficient as possible. And that becomes even more pressing as timescales are squeezed and we move to a 4-week nomination period in resales. Now, this slide here shows some of Resi's key statistics in comparison to some recent figures I found showing estate agency averages across all residential properties. Now, I'm not going to go through each of them, but you can see them on the screen. And while some of these figures are great, I'm not going to claim we're perfect yet. There's a lot of work for us to do. And these are measures that we constantly monitor and are striving to improve. But I think it's worth pointing out a couple of things here. Arguably, shared ownership transactions are more complex. You've got 3 parties instead of 2. You'd naturally expect longer timescales. But this doesn't seem to be the case when we look at our figures. And there are also some clear areas where we do better. Particularly, I think we're better at explaining shared ownership and ensuring people buy the maximum share that they can afford. You can see where I've circled here that 35% of our buyers purchase a higher percent than the outgoing seller owned. But when we compare that to ones that have gone on in the open market, it only happens with 11%. Now, that's quite a big difference. And it's a Homes England requirement, obviously, to maximise shares purchased. And it's of benefit to the customer in the long run to own more of their home. So we see this as a big success area for us. And I think the ability of our consultants to explain shared ownership to customers, to really proactively drive a transaction forward and ensure we find buyers even in more challenging markets, that's fundamental to our ability to keep improving these statistics. And on that sort of subject of proactivity, we're constantly looking at ways to drive business and educate customers. That might be through incentive campaigns, which we run annually. It might be through webinar and education programs, or it might be through technology that enables us to know who's looking, what they're looking for. The whole point is we don't need to be passive. We can really be proactive in driving business. But to do this, we also need to think carefully about who we employ and what their skill sets are. So we want people with a diverse skills and variety of backgrounds. And by bringing together people from estate agency backgrounds, sales backgrounds, shared ownership backgrounds, we can build a team with really complementary skills who can learn from each other and hopefully can match the service that a commercial estate agent might provide. I'm not saying we want to be the next Foxtons, but we definitely want a commercial spirit to drive our ability to make home ownership possible for more people. So we talked about people. Let's now talk about technology. Over the past year, we've been faced with some really big challenges in the new lease that require excellent technology. So let's look first at key information documents, or KIDs, as they're affectionately known. I think they live up to their name. I love them and I'm frustrated by them in equal measure. I love the transparency and the information they provide customers. But the challenge of delivering them cannot be underestimated, particularly for larger organizations with multiple systems and sources of data. I tried putting a KID together manually. It took me roughly 10 to 20 minutes for any specific property. Now, year to date, we've so far seen about 25% of our resales have been on leases that require KIDs. So from 2016 grant funded onwards. And this percentage is obviously going to increase. Now, that would result in several extra days work each year, and I don't have the capacity for that. So we absolutely needed to automate the KIDs. And not just from a time perspective, but from an accuracy perspective. You know, there's a huge amount of manual data entry in kids, particularly numerical data, if you don't automate it. And that will always lead to errors. And I'm pretty conscious, I'm sure we all are, that any errors in kids could well be the source of complaints in future. So automating kids for us is a project that's taken about 4 months. It was quite complex, but successful. We started rolling them out in January, and so far so good. And I just want to share a little glimpse of something with you, because it now takes us seconds to produce a kid. This is the back end of our CRM on a test property. And I have a little button that I can press. So I just show you here. And this will produce a kid. I was going to show you a different one. I realized I clicked on the wrong one. So hang on a second. I'm going to show you a different one. That's quicker. I've confused it. Apologies, everybody. This is the technology. When it goes right, it's beautiful. When it goes wrong, it's not quite so good. There we are. We're fine again. Here we are. So this is a kid. As you can see at the click of a button, this is my kid. Everything is absolutely populated. You can see here it hasn't populated 25 or 30% because this person owns 40% already, so it's not applicable. So it's all the data is there absolutely instantly. So kids have absolutely been a success story for us, but not without a lot of effort. And I think let's not forget it's not over. April the 1st. We'll bring service charge and rent changes for everybody. So you'll need to do kids again for any properties that are live on the market. So that means that automation becomes increasingly important. Another area I think where technology and efficiency become important is the customer journey. We're moving obviously to a 4-week nomination period. We can't waste any time. So gathering together the documents we need to list a property, get it onto the website, arranging viewings, all of that needs a really slick process. And we need to ensure the buyer and seller journey is as smooth as possible. So over the past year, we've been developing a digital portal that allows our customers to upload all their documents online, arrange viewing slots online, check who's viewing and when, and sends them triggered email updates at every stage of the conveyancing process. Now, this has had a fantastic ability or impact on our ability rather to communicate with customers in an immediate and efficient way. Now, that's really for the seller, but also important, obviously, is the buyer journey. You might have seen sort of some version of this pyramid before, showing the stages that a customer goes through when purchasing a product or service. So from our perspective, at the awareness stage, the end of Help to Buy agents means we all need to be part of the drive to raise awareness of shared ownership and generate our own inquiries. But this requires marketing resource and budget. You need to advertise on a wide range of marketing channels to find buyers. Now, our own website has thousands of visitors per month, but it's only one of many channels we use. We also know that finding the right home to purchase can take a long time. So whilst customers are considering their options, we need to nurture and educate them. So we provide them with easily digestible information. We've got short videos, longer form brochures they can read. And essentially, we need to make it as easy as possible for them, allow them to sign up to property alerts, arrange viewings online, get, text reminders, etc. And then once they do proceed, we need to make sure the approval process is smooth and efficient. And we can't do this alone. We use an online platform, for example, to do automated anti-money laundering checks. And we obviously rely on our panel of IFAs and solicitors who we can trust. And most importantly, we need great people, obviously, who'll hold the customer's hand along the way because they've probably never done this before. And ultimately, we want a happy customer, and we want that happy customer to tell others how great their experience has been. And we at Resi place great emphasis on getting reviews, and we actually incentivize the team monetarily to do this. Now, we talked a lot about resale so far. So in the last section of the webinar, I just want to touch on staircasing, and in particular, the new 1% staircasing that's part of the most recent lease reforms. Now, as I'm sure you all know, we've got to gear up to send all new leaseholders 1% calculations in April, essentially. We're getting ours ready to go on the 1st of April. And then we need to be ready to provide further calculations at the drop of a hat if requested. Now, if one of our shared owners wants to buy 1%, I want them to know how much it will cost at the click of a button. And I want them to have access to all the information they'll need to make that decision so that it's completely effortless. But obviously, a lot needs to go on behind the scenes for that to happen. you may know that Resi's been offering 1% staircasing to shared owners for several years. So we've got a lot of experience and learnings that we were able to use to make the 1% process even better. So I just wanted to give you a glimpse of what it will look like for the customer. So again, using our portal, the customer will be able to log on and have the option of buying 5% or more or 1% or more. This will only show up, obviously, if we know that they've got a new lease. Then the next, if they start saying they want to buy 1%, it will instantly tell them, because it's linking through to HPI data, instantly tell them how much it will cost. So we're given 14 days to tell them, but we're telling them in less than 14 seconds, which we're really excited about. And then they can decide whether or not they're ready to buy. If they're not ready yet, they can log on at any time and see that calculation. If they are ready, it will confirm their purchase and tell them the information about when the valuation expires and what percentage will be. This is based on a test version that hasn't got a share in, but it would tell them what percentage it would be. So I think that's an awesome platform for customers. It's instant, and I hope it will encourage people to purchase that 1%. But I guess some people might be asking, is it worth putting all this work in for such small premiums and potentially, small volumes of clients? So I just wanted to give you some context of our experience in offering sort of 1% for several years. What we found is that around 6% of people who signed up for the option, because we asked them to sign up originally, took it up each year. It's not a massive percentage, but it is actually more than the percentage of shared owners who staircase each year. And we didn't do anything to promote it, which we will be doing going forward. As an industry, I think we need to raise awareness that it's an option. And it's worth noting that nearly 60% of those who did staircase once went on to staircase further 1% increments. And around 20% of them went on to staircase in larger increments beyond 1%. So I think it's a really great scheme to achieve what we're all striving for, which is encouraging affordable home ownership. And we're a really big believer in its potential, which is why we've invested significant resource to educate customers, raise awareness and drive take up. So hopefully, I've covered some of the biggest issues I think we're all tackling at the moment. We've been pretty busy. I'm sure you can all say the same. So I just wanted to touch lastly, I guess, on what have been our biggest learnings from these experiences. So it sounds simplistic firstly, but document everything, I think. We all know the importance of policies and procedures, but how often do we review them? Do they really serve the purpose we need of them? I think when things are changing rapidly, you really need to dedicate resource to make sure that there are clear, up-to-date guides and process maps, both for your team, but also for IT team who are supporting making things better. Secondly, and I'm sure you all know this, you can never provide too much training. We're all creatures of habit. We revert to embedded processes. And right now there's been a lot of change. So we cannot train people enough, I think, particularly when they're doing something intermittently. I think thirdly, don't underestimate the importance of a good CRM. They're incredibly dynamic. You'll be forever making changes and improvements. We brought in Salesforce several years ago. It is a constantly iterative process. That means you need to make sure you have people around who understand what the potential of that CRM can do. It's not enough just to have a really great IT team. The people working in after sales need to understand what CRM can do for them and drive change and improvements. And I think finally, automation and digitization is no longer a nice to have. It really is a hygiene factor. I think customers expect it, so we need to deliver it. Having said that, we need to remember that it's an enabler rather than a panacea for success. Brilliant people are clearly still key to success. So I hope that some of what we've covered today has been useful. I know that there are a wide range of people listening who'll be dealing with different volumes or be at different stages of developing their after sales team. But I think whether you're new to after sales or worked in the area for decades, I know that we can all benefit, I think, from learning from each other and sharing our experiences. We're really keen at Resi to help others who are facing the same challenges. We want all shared owners, no matter whether we're their landlord or not, to get the best possible experience. And for that reason, we work with lots of other organizations already and have taken the burden of after sales off their hands. So if you are at the stage where you feel like you could benefit from some of our scale, our technology or our experience, please come and chat to us. Equally, if you're not, you just got some random questions, want to chat, we're also here and happy to speak. I put my contact details on the screen there, and also my colleague Mark. He's not on this call, but he heads up our partnerships at Resi Partnerships and is always happy to speak to anybody. So at this stage, I think what I will do is open the floor up to questions. There is I think a little Q&A box at the bottom of your screen that you may have been looking at already. Please fire any questions that you have in there. I'll give us sort of 30 seconds of a piece to think of what question you might have, if any. So I can see one question in there around what are some of the biggest challenges we faced when implementing the sort of technology behind 1% and the key information documents. And they were both big challenges. I think for key information documents, you'll all know there's a lot of data that needs to go into them, and getting that data in the format required, breaking down the service charge into all the different elements that is required on the KID, how to deal with managing properties where there is a managing agent. We might not have the data in that granular level of detail. The data is held in multiple different systems. Those were some of the biggest challenges that we had to face, and probably some of the reasons why it took several months for us to get that process really working. And the same again, it's all often always data-led. On the 1% side of things, ensuring that the data we held matched the data that was in the house price index was also one of the bigger challenges, because those two data sets needed to match up properly so that we could pull the data we needed from HPI. So yeah, data is always one of the biggest challenges we face. So I've got another question here around how long the 1% HPI valuation lasts before a new figure needs to be calculated. So that the lease stipulates that, or the Homes England rather stipulates that they're valid for 3 months and then it expires. So we have to provide them once a year at the same time as rent is reviewed. And then we have to provide them at any time that a customer requests them. Either we provide the one that's still valid. Let's say they request it again in May and it was valid in April, we provide that one. Let's say they request another one in September, we have to revise that calculation. So you could be providing at worst 4 calculations per year for any individual leaseholder. And then we have a question around here about the exit of Help to Buy agents. I think that's something that's on a lot of people's minds. How are we assessing and keeping records of eligibility? That's something we're in the fortunate position where we haven't been reliant on Help to Buy agents for a long time, because we drive the vast majority of our inquiries come through our own website or from Rightmove, Zoopla, etc. So we've all for a while had an apply to buy form that is completable through our website, which asks all the questions that the Help to Buy agent would have asked around eligibility, and that's recorded on our CRM for audit trail purposes. So I think we're quite fortunate. I know that there are other providers out there who have been very reliant on Help to Buy agents to drive inquiries for resales transactions, and this is going to be a massive change, I think, because getting those leads in, it does require a lot of marketing activity, and we have I've talked about our after sales team, but we have a whole marketing team supporting that after sales team. So I know that in some housing associations I've spoken to, the resales team do the marketing as well. They really are massive multitaskers, as we saw in that poll. Now we have again separated out, so we have a separate marketing team who are responsible for generating inquiries across both our new builds portfolio, obviously, and our resales. Another question here around, have we done any modelling on the effect of the new model lease and the service you provide? Are you expecting a rise in transactions? And if so, how you would deal with this? Interesting question. I'm not sure that the new model lease, it's very early days, obviously, to say what the true impact is going to be, in all honesty. We only have a small number of properties, or a very small percentage of our overall property portfolio is currently on the 21 to 26 lease. That's clearly going to rise in the years to come. I don't know that there's enough awareness of it right now for the actual new lease to really generate new business and shared ownership. I think there are probably other more impactful drivers, like the ones that Jon was talking about earlier, which will drive people to shared ownership. You know, the higher prices in general and the lack of affordability of buying your home outright, I think will have more of an impact on shared ownership volumes than the new lease. I think the new lease is just, it's a nice to have. What we do need to bear in mind, obviously, is do people start looking at older lease shared ownership and comparing them to new lease and saying, oh, I'm not getting such a good deal on my old lease. You know, if I look at a resales property that's got an old lease and then I could buy a new build that's got a new lease, you know, that's not so great. Now, we've done some things ourselves where we've tried to match some of those benefits across all of our properties, to try to kind of reduce, I guess, the differential between new lease and old lease, but we can't do that across the board. So I think that's going to be an education piece. You know, you can pay more and buy a new build property and you can get the benefits of a new lease, but equally, you know, there is a premium attached to that. So it will be interesting to see. I don't think it's going to have a massive impact though in the medium term, to be honest. See if there's any more questions come up. There's a question around, more for Jon, that there's been some kind of talk, I think, in the press around rent and how people are struggling perhaps with higher rental prices. Interested to hear your thoughts on how that might affect the shared ownership market.
Well, I imagine the reasons are also linked to what we talked about before, the interest rates. So buy-to-let mortgages with higher interest rates on, the landlords need to push up the rent. And if that happens, or as it's happening, it's only going to fuel shared ownership even more, as people look at different options to buy, can't afford on the open market, drop into shared ownership. So it just drives the traffic towards shared ownership.
Yeah,
so
hopefully.
The benefits, if you like, to us.
Yeah, and I think it's good to think about that, because there has been quite a lot of doom and gloom around recently. And as you know, as we mentioned, there was definitely we all benefited from the stamp duty, and then there was definitely a bit of a sort of a downturn. But I think that we can see signs that things are really picking up, and there are a lot of really good things to recommend the shared ownership market going forward. See if I get any more questions. I suspect there's some people really thinking that they want their lunch now. So what as we got to 12:45, what I would say to everybody is that for those that, you know, do have a question that they want to ask, maybe in a more a less public setting, you can still see our information up on screen there, and equally I can, at Jon's permission, I can pass over his contact details as well, should anybody want to ask any questions of him. We're really open to chatting. As I said, I think it's really important that within the industry we share our own experiences and really learn from each other, because we're all doing things slightly differently, and I think there's always stuff to learn. So all it leaves for me to say is to thank you all for joining us today. It's been great hearing your questions, and I look forward to hopefully speaking to some of you again in future. Go and enjoy your lunch. Thank you, guys.
Thank you.